All right, everybody. Happy New Year. I'm going to call the meeting to order. This is the JRIB, the Joint Retirement Investment Board, calling it to order at 7:06 p.m. here on January 26th. Well, it's nice to see everybody again. We haven't convened since early December, so this is our big long stretch, like the big dark side around the moon here. Welcome back. I hope you all had a really nice holiday. Before we get into the business, I would like to introduce, we have two new members with us. I want to introduce Tom Collymore, who is appointed to the Police and Fire Board, and I want to introduce Jim Brown, many of you know, who has joined us on the town employees retirement fund. And Jim, fresh off of his time as chair of the Board of Finance in town. Just so you know, everyone, I did call him tonight. He got sworn in today, and I did let him know we're a little less formal than the Board of Finance, so he's ready. So welcome. It's nice to be able to run with
Good to be here.
Thank you. All right, let's go. Brian Binkley, it's really nice to see you again. I'm glad you're here. Look forward to the presentation. All right.
Good to see you all as well. Good to see you, Carolyn. Tom, good to see you. Tom and I know each other from previous lives, so it's a nice to see his face and name as part of the JRIB. And Jim, I look forward to getting to know you as well. And please reach out if you need any history. Be glad to walk through anything on the Vanguard side offline as well.
Great to see you, Brian.
That goes for you, Tom, as well. Thanks.
So I gotta do my part first, Brian,
Okay.
and then I'm gonna hand it over to you. We're gonna do the minutes.
Okay.
So on the agenda, first thing we're doing is to hear, consider, and approve the minutes of the December 4th meeting. I have a request for a change. Chris, if you're there. Okay, so if you go to page 3, under item number 9, under old business, the second line, it's stated that as of 6/30/2021, our plans, it says, are not 96% funded, and I'd like that word to be stricken and replaced with "and now are 96% funded."
Got it.
Okay. I'm not sure if anyone else had an opportunity to read through it. I'll give you a couple minutes. That was the only thing that I saw, but happy for additional sets of eyes.
I'll make a motion to accept the minutes of December 1
with the one change.
with the amendment.
Thank you. For a second. All right, Jack Mahoney is the second. Thank you. Of course, I expect our new members to abstain. So here we go. So I'd like to move to a vote. All in favor of approving the minutes with the amendment, please say aye.
Aye.
Okay, great.
Aye.
Do we have any abstentions? We should probably have two.
Go.
We have 2 abstentions, Chris, Tom, and Jim.
Got it.
Any opposed? Nope. Okay, the motion carries. All right, guys. All right, Brian. Ready. Next up for item 3, performance review, the Vanguard performance review. You have a long time to tell us about. Do you need to share the screen?
Please, Carolyn. Thank you. As we're waiting for that to come up, you mentioned the great funded status as of the end of the fiscal year. This doesn't fit anywhere in my presentation, but with regards to, I saw a public funding study from Milliman, who's your actuary. They put out an index, and of the 100 largest public funds in the U.S., I think we're at the end of the fiscal year around 85%. So, think of the big state plans and teacher plans, et cetera. So, just to give you some kind of comparison about very large public plans out there. So, as we, thank you for blowing up the presentation. What we have this evening is Brian Scott will walk through just to ground us on the capital markets through the end of the year from a calendar year perspective. I'll move into the performance for the pension and the OPEB, which has both the calendar year, but your fiscal year to date, the 6-month returns. And then I also included some slides. I didn't want to put too many in there, but more have a discussion on our thoughts on interest rates, inflation, and as it relates to portfolio construction in a way. So I'll spend some comments there, and but more than happy at all times to address your kind of concerns, your questions as it relates to anything you're seeing, because we're certainly off to a wild start here after a great 2021. So with that as background, as far as what we'll cover, interject any time, and I'll turn it over to Brian now.
Thanks, Brian. Good evening, everyone. It's great to see everyone again. It feels weird saying Happy New Year this late in the year, but Happy New Year, everyone. And I guess Brian gave me the easy part. It was an exceptional year for U.S. capital markets. So with U.S. equity, pretty strong returns over the fourth quarter. That's against the backdrop of robust consumer spending, still at the time accommodative monetary policy, and an improving labor market. Domestic equities were up 9.2% for the quarter and 25.7% for the year. And this marks the third consecutive calendar year of returns over 20% for U.S. equities. International equities saw a slight positive return for the quarter of 1.8%, but still continue to lag U.S. markets. I guess the one caveat here is so far in 2022, international equities aren't down as much, so only about 4.5% through today's close versus the total stock market, which is down about 9.7% or 9.58% for the year. So holding up a little bit better to start the new year. Unlike equities, the U.S. total bond market saw flat returns for the quarter and negative returns for the year. That's really due to rising inflation and a shift in Fed sentiment. So at the December meeting, the Federal Reserve announced that they're likely to wind down their bond purchasing program in March. And they also are anticipating about 3 rate hikes for the coming year. Similar to the U.S. bond market, international bonds did not fare well. And we're also down. 2021 is the first negative annual return for both U.S. and international bonds since 2013. And then just a fun stat here, there's been only 5 years since 1970 where the Bloomberg's U.S. Treasury Index delivered negative total returns. So this isn't normal to see negative returns in U.S. bonds from a total return standpoint. One thing to point out, we don't hold any in the portfolio is non-U.S. bonds. We're down 7% for non-U.S. bonds that are unhedged. We're down 7% for the year. And this plays, when we look at the next page about EM returns, the U.S. dollar appreciated during the year. So that weighed on international investors as they receive international currencies. They convert this back to U.S. dollars. With a stronger U.S. dollars, they can purchase less. So we're seeing lower returns in unhedged products. On the next page, we're looking at returns for size, large cap, small, mid, and then value versus growth. And we started the year off with small value leading the way, but we ended up with large cap growth stocks ending up on top, slightly outperforming value. Growth was up 25.8% versus 25.4% for the year for value. Now, if we look at the far right-hand side of the page, we have developed market returns and emerging markets returns. For the EM, it was a very tough year for emerging markets. Some of this was due to the strengthening dollar that I mentioned. Another aspect was Chinese regulatory risk, which really weighs on the EM index. China makes up about 40% of emerging markets. So with their crackdown on tech companies, education companies, and then some restrictions around commercial real estate is really pulling down the index. If we go forward one page, we break out returns by sectors, and all sectors were positive for the year. And for the third quarter, 10 out of the 11 sectors were positive, with the only negative sector being communication services. So we saw exceptional returns out of energy. This is on the backdrop of stronger demand as there's a reopening trade, as well as lower supply out of the US and OPEC. All of the sectors from materials to the left outperformed the U.S. total stock market for the 2021 year. If we go forward one more page, This is looking at returns for fixed income by credit quality and maturity. We saw the Treasury curve flatten in the fourth quarter. So we saw short and intermediate or yields go up and the long end come down a little bit. And so when we look at returns by maturity, you'll see negative returns for short-term treasuries, intermediate-term treasuries, with the only positive for the quarter being long-term treasuries up 3.1%. When we look at credit quality, call it flat returns for treasury governments and investment grades, with the clear standout being high yield as investors still search for yield in this low rate environment. If we move forward one more page, and I'll end my comments here. This is just illustrating the yield curve, the teal bar being the where we ended the year at 12/31. You'll see higher rates throughout the curve compared to the yellow line, except at the very long end, that 30-year came down a little bit. And that's really due to investors not being on the long end, not being as sure when it comes to growth. So there's some uncertainty there if the growth story will maintain compared to call it the middle or the belly of the curve, the 2 through 7 year tenors, where they're pricing in Fed rate hikes. So we're seeing quite a bit of flattening there. And just, I guess, one last comment is we usually think of yield curves moving parallel, but you can see here that it doesn't always happen that way in practice, with the long end coming down slightly and the middle and front end rising. So I'll end my comments here. If anyone has any questions, I'll be happy to address them. If not, I can turn it over to Brian Binkley to talk about the portfolio performance.
Okay, hearing none, but interject anytime. We'll now just turn it over to the performance for both the pension and for the OPEB plan. Starting with the pension plan on a calendar year basis, well, I'll start with the quarter. For the quarter, still positive returns of 4.4% over the composite benchmark. Same would go for the fiscal year to date, the last 6 months, of up 4.8% versus 3.3 for the index. And then extending it out a year, while not as strong as where we ended the fiscal year, but still the calendar year basis, up over 14% on the 1 year basis, again over the composite benchmark of 11 point, around to 2. Any of the outperformance over the benchmark, mainly due to, in these short periods, are the private equity holdings and the private real estate, which are our two actively managed areas of the portfolio. I looked back, what does that mean, like in dollar terms? And of course, we have cash flows throughout the year, but we started the year of 2021 with 438 million. So this portfolio is going to 491. When I get to the OPEB started at 67 million. We ended around 80 million. So just to put things into terms.
Hey, Brian, I noticed on this chart you were able to add a policy column. Thank you for doing that.
Yes, yeah. So on the bottom part of the page you're referring to, right, Carolyn?
Yep.
Yeah, so we have our allocations, to each of the asset classes. We're all within tolerances here, something that we monitor, and we have regular cash flows in and out of the plan, in from distributions from our private equity partners, out, we're paying benefits on a monthly basis. So just looking at the allocations, we'll come to this in a little bit, but the private equity, the last one, the policy, prior to December was 5%. We increased that to 10. It's not reflected here. It's going to take quite a while for that buildup of the private equity to happen. It takes years. So it still says 5. There's a footnote to say the private equity target is 10. So the 7.5%, while there was an initial allocation to Harbor Vest in December, very small, most of that overweight is just from the legacy ones and the strong performance. And I'll come to spend a little bit more time in that, but all within policy targets, despite, again, the benefits that we're paying out of the plan. So moving to the next page is really, this first page here is really following the numbers that Brian just went over. Within the equity portfolio and the fixed income portfolio, those mirror the previous indices that Brian talked about because they are indexed. So if you're looking at fiscal year to date, that Vanguard total stock market index, which is inclusive of large, mid, and small, led the portfolio up over 9%. Brian talked about the weakness in international stocks, so down just 0.9% on a fiscal year to date basis. A lot of weakness in emerging markets. And on the fiscal year to date, the last 6 months, just a eked out gain for the total bond market index of 0.03%, and the international bond index was down 0.15%. So that's the fiscal year to date. Brian just went over the 3-month and the 1-year numbers. The very bottom of the page is where you'll see the roll up of the 5 private equity managers. So looking at that fiscal year to date number of 23.4%, that's over a benchmark, the historical benchmark for the private equity holdings, the Russell 3000 index, plus 3%, so down 1.6. If you carry that out to the 1-year time frame, you see that astounding 78.9% versus 21.5. So that explains the relative performance that I went over prior as far as where that outperformance is coming from. And if we toggle forward just to one more slide, has all of the holdings. You see the very bottom of the private equity, kind of in the middle of the page, HarborVest 2021 fund. So that capital was officially called during December. Again, a very small amount in relation to the total commitment, but that was at 150,000.
Okay.
So that's now showing on the performance reports. Real estate, I'm going to touch on that just a moment.
Sorry.
Yeah, no problem, Carolyn. Because that also had a really strong return. We think of real estate more in the risk reducing basket. A lot of the returns, over 50% of returns for private real estate, really comes from income. So you'll see here, this is lagged a quarter, just like private equity, but on a fiscal year to date, 10.3%, 1-year return of 16.3. So, real estate market has really come back. I do have received a flash report from Principal. So I just give you an update through the end of the fourth quarter while it's not official. The fourth quarter, their private real estate fund up 10.5% in the fourth quarter. And that was the highest quarterly return in the fund's 17-year history. So you can just see how much of that momentum carried over to the real estate sector. That 1-year number, again, unaudited, it's not released yet, just shy of 26%. So really boosting the absolute returns of the overall portfolio.
Hopefully that continues into January. We could use a little
Right, we could use a little love after January, right?
some love in January.
Yeah. Next slide is not something we always include. This is the private equity portfolio looking through the different years. When we've talked about private equity as an asset class, one thing that gets thrown around the term is the J curve. And this is, theoretically, but you could see this on the page. What means by the J curve is that dotted line. What happens in the beginning of any private equity fund is the private equity managers are calling capital to invest in the companies. So you're just seeing capital called, but no returns. So just looking at that dashed line, from when it started, your private equity fund started, the net cash flow was negative for many years. Now we're seeing that acceleration of capital being returned to the portfolio. So in that far right column of 2021, just to give the committee a summary, the net cash flow was 9.6 million positive. We still were getting distributions, we're still making commitments to some of the funds, but we're receiving more in distributions. So you could see that how it's turning positive. And if we didn't make a commitment to a new private equity fund, you would see that that allocation to private equity go down because of capital being returned to the town. So I just wanted to share that with the JRIB. You can actually see those numbers on a year-to-year basis. Sorry, the formatting on the calendar year got a little screwy at the very top of the grid, but I wanted to put that out and show you how much capital was returned in 2021.
It's helpful. That's good.
Great news, but no, good timing to re-up to private equity. But
Right.
just want to say thanks again to Jack Mahoney for shouldering that load with you. That was a lot of work.
Yeah, thank you, Jack.
No problem.
Next page is really just a summary. I think the last page, this just shows what was committed. We always include this, what was committed, where we are, but the last page is where I really wanted to put the focus on. So this just now we'll just a quick recap of the OPEB plan. Similar allocations, if you recall, but not exact. A little bit more equity exposure, a little bit more real estate exposure, so the numbers don't tie exactly to the pension plan. A little bit weaker on a fiscal year to date, but stronger on the 1 year return. So you see the fiscal year to date of 4.5, so you don't have to flip back 4.8 for the pension. But on a 1 year basis, because of that heavier equity allocation, it was up over 15%, 15.05 on the 1 year basis. Just like the pension, on the bottom half is the allocations. We don't really see much cash flow here, maybe a couple of times a year. So less rebalancing happening, though we still, of course, monitor the allocations if they stay within target. So with that said, I'm not going to spend any more time on the OPEB plan unless there's particular questions. Just on page 16, you'll now see the Harbor Vest funds, and they're broken out, one for fire and then, of course, for employees. So it's split here.
Hey, Brian, I had a quick question, and apologies if you've covered this. I am new, as you know.
Yeah, Tom.
Within CRE, is there one particular type of asset class that's doing well? I'm thinking of COVID and all that, and office buildings and movie theaters being affected. Is it what's doing well? Storage?
Yeah, certainly the industrial. And you think industrial, you think of the warehouses for Amazon, the like. Malls were extremely. This is more on the REIT sector because I can break down into sectors on the REITs. But looking at that, like self-storage was really big. Malls had a huge rebound by the end of the year, and some of the laggards were hotels and office.
Right.
In the commercial real estate. So really kind of a dumbbell there as far as the returns.
Thanks, Brian.
Sure. So why don't we page forward to page 19. Quick view of where we see, interest rates, or excuse me, this is on the topic of inflation first. So let's admit it, there was nothing transient about inflation last year. So, most forecasts, including ours, were wrong as far as not coming down fast enough. So where we see inflation, we still see it coming down from where we are now. How can we not? We're at like 40-year highs. And we see inflation by the end of this year, still over the Fed target of 2%, but more in the range of 2.3 to 2.6%. So we do see that easing. Who knows when exactly the supply bottlenecks get relieved, but we're seeing some release there. It's more, we're more concerned is more in labor, given the shortages that still plague many industries. And then there's the real estate components, and those factor into any kind of inflation reading. So that's where more of the concern is. And the next two slides really highlight that, labor shortages across many industries, putting pressure on the wages. I think that's top of mind for most employers. And then on the next page, it's just showing, we had a lot of retirements, or a lot of people just left the workforce. And so why unemployment is falling back to like pre-COVID levels, the total participation rate in the economy may not return to where we were pre-COVID. So that will be interesting to watch. Well, since there's topics of inflation, how do we think about inflation as it relates to structuring and portfolios? So with respect to the town, I'll just say straight off, this is more of a total return approach because, how long-term the return objective is for the plans, right? We have a long time frame. And therefore, we're not thinking of this as far as spending as a retiree would, or even in some foundations, which have, a big part of their operating budget is returns from the endowment. So if an investor was really concerned about protecting the corpus from unexpected inflation, we think the two best hedging asset classes are short-term tips. So in the bottom right corner of that shaded box, or commodities, but they both have trade-offs. So with short-term tips, that x-axis talks about the correlation to inflation. So short-term tips have the highest correlation to unexpected inflation, and that should be no surprise, right? If there's inflation, Treasury inflation protected securities are going to go up by the exact amount of inflation. So very strong correlation. The correlation for commodities is not as strong, but high. The y-axis is when you think about your portfolio, just not yours specifically, but generically, if you held tips in the portfolio, as some investors do, tips only protect against unexpected inflation for that amount of allocation. If you had 5% or 10%, it doesn't protect the whole portfolio. It only protects that allocation that you have to tips. The opposite is a little bit true on commodities. So if you commodities have more beta or more sensitivity to interest rates. So if you had a 5% allocation to commodities, well, you tend to see bigger swings because they're more sensitive to inflation. And I'll give you some statistics just from last year to how this worked itself out. So short-term tips last year were up around 5%. There's some yield from the securities plus inflation, but commodities were up over 25%. So you could see that sensitivity to inflation. The downside of commodities is they're extremely volatile. You probably saw that in the past when you held some investments there. Over the last 10 years, I think it was one of the worst asset classes. It's very volatile. So I wanted to provide that perspective. I'm going to bring you back to where I was saying the total return approach on the next slide. So over long periods of time, really we view equities as your best inflation hedge, over 10, 30 or longer periods of time. Equities can adjust over those periods and account for inflation. They even did last year, right? We had a high inflation, but most companies were able to pass that through, and that's why they were still up over 20-something%. So from a portfolio construction perspective, taking the long view to protect the portfolio, grow the corpus, it's equities. Bonds are there to provide that ballast in down markets like we have this year, and to get some return that we're not getting much with very low interest rates. You could see how little return commodities and treasury bills, short term, provided over long periods of time. We have a whole white paper on this that we wrote about 2 years ago, but it seems pertinent to the topics right now. So I wanted to share those views, even though I don't think there's anything that we should do to the portfolio.
I appreciate your bringing these slides forward, right? Because that, of course, it's something we have to consider. I'd love to see the white paper if you could forward it that my way, and I'll send, or if you could send it around to us in the JRID.
Okay, I'm glad to do that. So I'll have that as one follow-up item, and this was just to pull 2 slides from that since it's so pertinent and investors are asking. From there, I just also another white paper that we wrote, just, the role of bonds in the portfolio. And we've talked about this a little bit. Just 2 slides is just to give some historical context. This is since 2008. And we call this internally the spaghetti chart or the hair chart. It's got a lot of nicknames, but what this is showing you on this slide is for each year, what were the forward rates or what were the future markets predicting what would happen to the Fed funds rate? And year after year, quarter after quarter, the market was anticipating increases in rates. And the green line is what really happened to the Fed funds rate. So the conclusion of the slide and what we think from an investment methodology is very, very hard to predict what's going to happen with interest rates. And so if we're ever to introduce, active back into the portfolio in the fixed income side, we don't want to bet on duration or, the sensitivity to interest rates. You want it to come from security selection. So very hard. We hear this from a lot of our corporate pension plans that are, more sensitive to changes in interest rates. Oh, the rates are going up this year. This is going up this year. You just don't know. And then the next slide is just saying, I talked about the purpose of fixed income in the portfolios to provide those protection in down markets like we're having just in this January, the first 3 weeks of the year. But really, when you think about fixed income, so there's worries of in a rising interest rate, well, our fixed income investments are going to lose value. There's no question that that's a concern in the short term, like we saw a negative return for the Barclays aggregate last year. But over longer periods of time, most of fixed income return doesn't come from the price return, it comes from the interest off of the portfolio. So over longer periods of times, you as an investor, we want higher interest rates to earn a little bit of, from fixed income. And that's certainly been lacking the last several years as the Fed has held rates down to 0. So just that perspective might get some negative returns when rates rise, but longer term, it's better for the portfolio. So a lot of topics. I always feel like we're talking a lot. It's easier in person. I'm going to leave it there. There's some market outlook comments, but to be frank, those are changing just as much as on a day-to-day basis. Look, the Fed spoke today. It looks likely, raising rates in March. So I put that for context, but the outlook is not really going to shift what we do in the portfolio, but always want to make you aware and what our economics team is thinking. So again, covered a lot.
Yeah.
What questions could I take?
So you want to keep us long equities and long fixed income? Keep the exposures kind of where we're at?
Keep our exposures where we're at, and always thinking about this with respect to that discount rate in the portfolio. And I know that'll be a topic that'll come up as we move through the year, come closer to the fiscal year, and have the actuary back in. But the pressure will remain on discount rates to come down, for public plans, even for corporate plans, but for different reasons. And that's because rates are still low, and valuations. Well, at least I didn't include this, but we haven't seen valuations in the U.S. equity market this high. Not as the same as the tech bubble, but they're very overvalued in our opinion right now as far as U.S. equities. And so, not surprisingly, this year, where we're going to see in a lot of the biggest air pockets, it's been more on the growth companies, the tech companies, because that's been the more richly valued segments of the market. So high valuations are reducing our forward-looking returns, and then low interest rates, at least so far, have been keeping our forecast for fixed income, say over the next 10 years, pretty muted as well. But I would stay the course and thinking about the portfolio construction in light of that discount rate, and also where we are with funded status.
Anyone else have any questions or thoughts?
What about international, right? Because international obviously has underperformed compared to U.S. the past little bit, but with the U.S. equities that, probably overvalued, I guess international would be considered undervalued. to different regions, right?
Right.
Europe is 20% undervalued for high quality companies, right? The big chip companies in Europe compared to
Right.
blue chip in the US. So obviously Asia, it's going to be even more than. Do we have the right balance? You know, not making any changes now, but
Yes.
should we be watching the international? Should we be shifting potentially more into international if there is some sort of correction?
So
in the US?
yeah, so to your point, Eric, is our view is been the same. It's, you know, I might have shared this at the last meeting, like US equities, you know, I shared, and I'll be glad to send it around as well, is like how have our forecasts done the last 10 years versus what's actually happened. And US equities over the last 10 years have outperformed where we thought, and US international equities have underperformed. But we still hold the view that over the next 10 years, international equities will outperform US mainly because of the valuation difference that you reference. So I'll include it in the next month's meeting, but our return forecasts look better, in some ways material versus US equities because of that valuation difference. That's the biggest component, not the only, but the biggest. We have within the town's portfolio, just looking at the equity exposure, 60%, 40% allocation to those two, to those two asset classes. I think I would still say I think that's appropriate. So you still have good exposure in the plan should international equity return. What we've found historically is as you increase international exposure above that 60-40 band, you start to incrementally get more volatility because historically international equities of a component which is emerging markets is a component of that tend to be more volatile. So we can think about increasing the allocation, but once you hit that 40% and bring it up to 50, just being mindful that we'll add a little bit more volatility into the portfolio as well. So that's the two trade-offs we think about. One last comment on that is if you just look at the global market cap of the markets right now, US markets are about 60% of the global market cap. So we almost have that same construct. We're following a global market cap approach with US being 60% and international or non-US stocks being about 40%. So we're also kind of market proportional as well.
Mm.
That might be a good slide to show the committee in the future as well. I'll write that down. Does that address the question, Eric, and kind of your thoughts?
Yep, thanks.
Brian, Eric Caliper here. I just have a quick question. A couple
Eric.
of weeks ago, there was an article on Bloomberg talking about some of the major investment houses setting up crypto desks, trading cryptocurrency. Now, as you see some of the endowments and other large position money managers moving into crypto, what is Vanguard doing right now? Are they looking at it? Are they considering it? Are they investigating?
I'll share, some of our thoughts. We've written on this before. We don't really see it as an asset class, Eric, and one of the big reasons is just the volatility that's around some of these cryptos as well. So, is it really a store of value if it could drop 50% in, a couple of weeks or months? Some of our endowments and foundations, looking to hold some of these cryptos. So while we're not advocating it as an inclusion to the portfolio, I know that from a brokerage standpoint, we're looking at how we can hold that if, they're gifted, to an endowment or foundation, which is a big part of our OCIO business as well, but not taking a view from it. We're not recommending crypto from an asset class perspective and a portfolio construction.
Can I ask a follow-up question on that, Brian?
Mm-hmm.
Where would you place it if it's not its own asset class? Is it a currency? Is it a commodity?
you know, I think you think of it most as a currency, but you know, with the maybe the exception of Turkey recently or Argentina, you don't see that type of volatility in a currency. And, you know, currencies are hard to predict movements as well. Um, Good question, Carolyn, and I think the answer would be maybe just in the currency side. It's not hard to say it's a commodity. Maybe there's only so many of them, right? You know, that could
You
be
don't,
mined.
but you don't trade it in pairs, right? Currencies are always traded in pairs. There's a long and there's a short on a currency trade. That doesn't seem to be in existence on a crypto trade.
Yeah, and there's so many cryptos, right? I mean, we
So
think,
to me, it's more like a gold, right? Which is a commodity. I don't know. I mean, I asked
right.
you just out of curiosity. I don't know how to place it.
Yeah, no, it's certainly still a fascinating topic, and I think one that'll be around indefinitely. And you know, the central banks are trying to figure it out as well. That's for sure. I don't think they want something replacing their own currency. Uh, so I think there's more to come, but we're not looking at it as far as as an investment for our long-term investors. I know we did a short blog on it. We haven't done a white paper on it, but I know we have one of our economists has done something short, and I'll send that to the committee as well. So thanks for the question, Eric.
I'll just add, it's tough for a portfolio to maintain on the efficient frontier given the volatility, unless Bitcoin specifically returns about 30% in a given year. So it makes a portfolio inefficient based off of forward projecting, assuming Sharpe ratios are constant. And then I would say internally, we don't look at it as an asset class per se, but we're very bullish on the technology. We have a fintech team at Vanguard that has or is looking to employ blockchain technology for settlement reasons, specifically around securities lending. So we are exploring the technology itself, but we're not as bullish on we'll call it the asset class.
Tom Calamar, you look like you have something on the tip of your tongue. Do you have anything you want to add? Uh-oh, still muted.
I've got the mute unmute predicament, of course. I was just thinking that Fidelity was in the paper at the Wall Street Journal this morning, and Abby Johnson is apparently all over Bitcoin, and I think it reflects the different cultures between Vanguard and FMR, and I'm more comfortable with the Vanguard culture, actually. Thank you for the question, Carolyn.
Thanks, Tom.
Sure, Brian.
All right, anyone else? Any other questions? If not, we'll move on. Brian and Brian, thank you. Awesome again. Really appreciate it. I got to tell you, I'm not looking forward to seeing the January performance report. Having had a sneak peek of some of the performance month to date of some of the large hedge funds out there, it's not looking pretty. Maybe we get a nice stabilization here in the next few days.
Yeah, let's hope. It's been wild because of how you know the markets have been down so much and they've come back so quickly, and even in a day. So no question, more volatility to be expected with really the Fed is the biggest wild card and what happens with rates and how much the market can handle. And then on a more serious note, you know, the geopolitical concerns, you know, up in Russia. So, you know, that's certainly a factor, right? And that can impact energy markets. It can impact so much beyond the obvious loss of lives. So geopolitical and certainly monetary risks out there.
Well, you'll have a lot to talk about in next month.
Yeah.
Thank
Happy to stay on. Would you want us to stay on, Carolyn?
Yeah, if you would,
Sure.
I'd be curious because we have up here, you know, IPS review. I just want to kind of tee that off. So yeah, please do, and you're always welcome to stay. All right, we could move on. Jared, I think this is going to be you, the plan administration update. Kind of where are we in that process?
Sure. Hi, everybody. And also Happy New Year, a little bit late. So I got 3 things to report on that front. One of them is that the question came up from Eric Calper, I believe it was the last meeting, about plan documents, pension plan documents. And I know that Mr. Hazelkamp had already started down that road and working with an attorney to come up with those documents, which is the town hadn't really had prior. The last thing we have is a document from 1970 something, I believe. They have a draft of a plan. I know that he intends to distribute that to the appropriate unions for their review, just to be sure that everything is, agreeable and understood by everybody to be what the benefit should be. So. That's one thing, and that's a big thing. It's going to be important as we move into our services through Milliman. And by the way, I should have started out with this because I know for Jim and Tom, one of the things that we did, I don't know if you guys were aware of this or not, but we agreed to allow Milliman to do the full pension administration services for retirees, and so it's going to be a months-long process, and so we're starting down that road now. We have a draft agreement with Milliman that we're reviewing now, and then so hopefully that will get approved soon, very soon. And then another thing, which is not really related to this, but has come up over the last month in my conversation with our HR department, and probably I'm surprised that it didn't come up months ago. There was an issue, if you remember, when People's Bank was acquired by M&T, that they weren't at the time. They weren't going to continue to provide services for the check writing and distributing payments to retirees. And then at the 11th hour, they came back and said, "Oh yeah, we are going to." But in the process, we had actually pretty much entered into agreement with a company called Penchecks to take that over because we thought People's was getting out of the business. They didn't. We stayed with them just for continuity. As it turns out, I think there's some discontent with what the statements are, the pension statements and advice that are in the pension documents from People's, and it's not, not giving enough information to the retirees. So, I'm putting it out there that we possibly pursue another company. I did talk it over with Mr. Foley, Gerald Foley, our purchasing director, because at the time when we were going to go with Penchecks, it was more of an emergency type of situation. We had to act quickly, and so we streamlined that, and just started down the road with Penchecks. Now it's not so much of an emergency, and so we will probably have to do an RFP for this. If it's, if that's the will of the board. And I think that's all, that's what I have on this front.
Yeah, we had, if guys, correct me if I'm wrong, but when we first were confronted with the People's acquisition, People's being acquired, right, and them discontinuing the service, we had thought we would go out to an RFP. And so I'm comfortable with going out to an RFP on this, if the rest of the board is. Yeah, don't know if you want to discuss it any further. I mean, if this is the view of Gerald Foley and our purchasing department is the proper way forward, I think that it makes all the sense in the world for us to commence that process.
Could I ask a quick question? This may be off topic, and just shoot me down if it is. But I noticed that the People's Liability Insurance is the only fiduciary liability insurance broken out on the income statement. Is there a reason for that? I'm just curious if People's in some respect is special or even unique getting that treatment?
That's a good question. I can find out about that.
I don't think I'm guessing it's not important, Jared, but I'm just surprised that that particular liability insurance policy is broken out, and it kind of makes me wonder. Well, I assume there are other policy premiums that aren't listed, and if not, where would you find those? And I assume, for example, board members have liability insurance. It just prompts a few questions in my mind.
Yeah, the board. My understanding has been with the board members is that they're covered under the town's kind of blanket liability insurance.
Okay. Okay.
So that's probably why you don't see that particular. But I will inquire about others and
Thanks, Jared.
and let you know. Yep, you're welcome.
Going back to that discussion prior to with the RFP, I thought that was a couple months ago when we were having that issue. We're going to move forward and just so I'd be supportive of moving forward with an RFP, looking at the new services and see what's out there. It's always good to be doing that. And given that we had a little unexpected, situation with people, even though they step back and it is important to see what's out there, see if there's a competitive and who's out there.
Jared, I just wanted to, I don't know, make you guys aware, I don't know, there is a portion of the Board of Ed side that is not that's covered by the pension that's not in a union, and I want to make sure that that documentation gets to the right people, because there's no one to review it for those members that aren't covered by a union. Me being one of them.
I'll make a note of that. Okay.
I don't know if you want to go through me, but I think maybe you would go through, I don't know who would go through, maybe our CFO, I guess. I mean, maybe, I'm not sure. So just kind of touch base with the board side. And then going on that, I don't know if this is the right time to talk about it. Maybe it's something in the discussion with the transition to Milliman. But I was made aware that apparently at some point in the history of current pensioners on the BOE side, that the contributions were originally made, some were made pre-tax and then it was changed to post-tax. So I don't know how that's going to affect the calculation of benefits down the road. And I don't know who they would communicate, Milliman would communicate and find out how that was done and when that was done and what that would be relevant to them in their pension calculations going down the road. So, we've got a lot of turnover since that was done. I think it was done under the Bonnie McWayne era. So we're going back 15 years, but we do have many pensioners still under that. So just something to keep you aware of.
Right, and hopefully they caught that as they were doing the documents,
Okay.
as they were doing the plan documents, but I'll make a note of that as well.
Thank you.
All right, let's bring this back, guys. I want to bring this back to this potential, the RFP for a replacement for Peoples on the custodian side, right? This is on the custodian side. To kick this off, we'll have to take a vote on it. And so are there any other kind of, before we go to a vote, any other thoughts or questions regarding this? I would assume it would be done under Gerald Foley out of the purchasing department, same as we went through with the actuary, right? We'll probably set up a committee here among us to review the respondents, and Gerald will guide us through the process. Okay. Okay. So, may I have someone like to make a motion?
I don't think, Carolyn, you can take the vote without it being noticed on the agenda. We had that issue one other time with the town attorney saying you have to notice if you're going to take a vote on anything.
Well, then, okay.
Why don't I'll make a suggestion that we take this, maybe take up the vote at the next meeting. We'll continue working down this road, going down this road on the administration side, but won't fully commit and actually go out and until we get the approval from the board.
Okay, so Chris, let's make sure that gets on with the proper wording.
Got it.
The next meeting
Thank you.
in February. Okay. All right. And then Jared, just the movement over to Milliman on the administration side. That's quick. So that's kind of terms. Just got kind of a sense of the contracts and the terms, and that's beginning to be reviewed.
Yes.
Okay. And let's make note of what Chris brought out of, let's make sure two things, that they understand that there's a pre-tax and a post-tax contributions on the BOE side, and there's a subset of people who are not represented by a union who will, we'll want to make sure that we're aware of. And I'm sure that in the process, we will uncover an innumerable number of other things that come up along the way. So, anything else on the plan administration, or are we ready to move on? Okay. So the next one, I put on here the IPS review, and I sent it around. Chris sent it around to you, right? We spent a lot of time on this. We approved it back in September. According to our bylaws, we have to approve it twice a year. And so I have submitted it around, take a look at it. We can approve it, we can vote on it next month. I think since we still have Brian with us here. I asked you the question earlier. It sounded like from Vanguard's perspective, the allocations are still right and proper. But maybe you want to comment further, just kind of guide us a little bit.
Sure. The main comment I would have is the objectives of the portfolio, time frame. You could always think about the risk profile, but nothing has changed with the overall objectives of the portfolios, and that's where we would most say, okay, maybe we want to reevaluate the asset allocation in light of objectives, risk tolerance, or time frame. I think those are the main things that come to mind. And with none of those really shifting year over year, say it's still a prudent allocation. We're pretty diversified. Well, we are diversified across most, if not, most asset classes, and then even within those asset classes.
And so if you would, guys, a little homework for you to do in the next couple of weeks is read through it. And if there's anything that you would like to bring forward, that will be the topic, one of the topics we cover next month. Okay. All right, we're going to go back to Jared with the CFO report. But he's not here. We see his wall. There he is. Jared, can you walk us through the CFO report, please?
That was quick. Okay. Sure. Do you guys want me to share my screen?
Sure.
Okay. Okay. So this is a quarterly report where you'll see all the 6 months of the since the start of the fiscal year. There, we'll start with the OPEB account for town employees. One of a question came up, I think, in the last meeting. They've also been Mr. Caliper about contributions from employer, and that. So we don't because we're not paying for the benefits out of this fund. There's a truing up that happens at the end of the year where the contribution from the town takes place to take into account the amount of funding that has been put into the budget and the amount that has gone out to the retirees. And so there's a truing up that happens at the end of the year where the funding, there's a calculation of what goes in, what's basically essentially what's remaining that goes into the fund. You see there interest and dividends, monthly custodial fees down below in the middle section, And you'll note, as Brian did in the investment performance, that with the Vanguard Harbor Vest, we are starting to make those payments now. You know, obviously at the bottom you can see the changes in values and the final ending market value of about 37.5 million. And the pension fund, yeah, any questions on that?
Well, can I ask you a question on that, Jared? So,
Sure, yep.
you know, so I get, you know, so the town sends to me, you guys send to me to do a review after you've done a review of kind of the, you know, to approve payments for, say, you know, Hooker and Holcomb, you know, the actuarial work, and that gets apportioned out to town side police and fire across the funds. So where would that be? That's going to show up in. Because we've got actuarial fees here for OPEB, but this is 2021. So
Yeah,
we just didn't account for it yet?
For Hooker, and I believe that we haven't accounted for it yet.
Okay.
But also, this is not a, I'm not sure how much would actually be allocated to them. You know, this not being an OPEB valuation year, you know, this is an off year. So there may not be a whole lot of
Right.
work done on their part.
Okay.
On the pension fund for town employees, you'll see, you know, most notably, you'll see in September, that's when we make the town contribution, budgeted contribution to the fund. The cash transfers in. These are transfers into the fund's account each month. The payments to pay.
Just a quick question on that. Going back, I think you responded to my email. My direct question was employee contributions. And shouldn't we be really capturing those monthly or at least minimum quarterly?
So and I think I responded to you an email that these are that there are journal entries made twice a year, in January and then in June. Traditionally, that's the way it's been done. Open to suggestions for other ways to handle that.
Where does that money sit? As it just sits in cash? It just sits in a money market fund? Where is it?
I believe it sits in cash, but I can get clarification on that.
I got a question. So on a monthly basis, is these accounts being reviewed by your team? Journal entries, you have movement. You should have movement of securities, realized, unrealized. You have monthly now. You have contributions, employee contributions, which should be technically being to the plan on a monthly basis for employees having some sort of their contributions in their agreements, and this should be reflected. You know, obviously it's a month or two off, but it should be updated monthly. And you know, especially employees are making these contributions, having withholdings. We need to be accountable that this money is in the proper place and not sitting in the town's general fund or bank accounts.
Yeah, let me confirm that before I say for sure one way or the other, and I'll get back to you guys soon on that before the next meeting. I'll send you an email response. Okay, the payments to participants. So these are actually the monthly benefit payments that are made and the associated taxes that are withheld related to them. Below that, health insurance, legal services, and then the other large amounts that that you'll see reflected in here, cash transfers out, which typically represent the capital calls that we get from Vanguard.
Is a Vanguard fee a monthly fee based on assets, or is it again? Is it going to be like a twice a year thing, or is it just being recorded twice a year when they get into it?
I'm sorry, can you repeat that?
I'll look at the line management fees. Right, there's only one amount, right, in 1 month. Goes if we're showing financial statements on a monthly basis. Is the monthly, monthly charge? Is it a quarterly charge?
Or quarterly, Eric.
Oh, it's quarterly. Okay.
So we go to the fire and police.
Sorry if I could interrupt. Sorry. If it's quarterly, why are we seeing it only once over 6 months?
So I believe the next payment would be in January and it would show up. So your question is, there should be one probably reflected in July if it were quarterly.
Right.
Yeah.
Right. Is that right? Is it just sort of on an irregular quarterly basis? Is that why we're only seeing it once? Not that this is your document, but is that your understanding as well?
Yeah, so the invoice typically will go out, the month after quarter end, July. So I would, whether it was paid in July or August, yeah, I wouldn't know, but the invoice would happen right after quarter end. So
Okay.
yeah, it would be a quarterly invoicing.
All right. So this is cash basis. So if we pay it a little later or a little early, it's still on the month that we're talking about.
Right.
Okay. Thank you.
And we'll still have to add in the actuarial fees, the consulting actuarial fees, because we did have Hooker and Holcomb expenses.
Okay. Police and fire OPEB account.
Okay.
Very similar to in terms of the information, very similar to what you saw in the town employees account.
And again, Jared, the only thing I would ask there also would be is if we could capture the employee contributions. I don't think employees make contributions on the town side OPEB, but I do know the uniform services do, so that would be helpful.
Okay. And finally, the fourth component, the police and fire pension account.
Sorry to interrupt again. I apologize. And I bet I'm the only one who doesn't know this. The 20,000 payable in connection to Vanguard Harbor Vest, is that some kind of setup fee for the private equity investing?
That was our first payment to them.
Is that an investment or a fee? I'm just curious.
That's a fee.
That's a fee. Okay. It seemed to be in the fee category. I apologize for asking. I just want to make sure I understand. Thank you.
And again, the police and fire pension, again, looks very similar to the town side. September, we get the initial employer contribution.
Still have work to do. Still have items to fill out in here, Jared. But it's
Yeah.
from where you started, you kind of create this spreadsheet to here. There's progress being made.
Yeah, and I can
Continue
work,
tweaking it.
Jared, just a quick comment. I can confirm maybe offline, but I don't know about, I don't see every invoice, but I know if the 20,000, I know that was what was called for each of the OPEB accounts. Like that was may have been the capital call.
Oh, you're saying that was a capital call?
That would be my hunch. Because I know 20,000 was called for both of the OPEB plans. So 20,000 for fire, police, 20,000 for employees.
Okay.
So my hunch is it was a capital call as opposed to a fee.
All right. So let me get confirmation on that. Any other questions?
When you build into it, can you make sure, please, add a separate line for Milliman actuarial and then Milliman pension administration?
Okay.
Okay, we should keep them separate as we review this going forward.
Will do. If there are no other questions, I'll stop sharing and. Fine.
Let's have one more question. I know like we have market value on ending market value on some of the schedules. Can we have them on all the schedules so we have or on a separate one seeing, the two OPEB plans have market value of XYZ, the plans have XYZ, so we have a sense of total assets under management as well. So on some of the schedules you have an ending market value.
I see what you're saying. Yep.
Thank you.
All right. Thanks, Jared. Anything else from the CFO report?
No, that's it.
Okay. I'm going to move forward here to old business. Keep you guys check your emails. Keep an eye on them. We're gonna need to call a special meeting sometime within the next kind of 2 weeks to hear an update on one of our outstanding legal issues and items. It's going to go before the selectmen first, and then we will hear a read-in. And we will then call a special meeting that will be largely executive session for that. Heads up, that's coming your way. Anyone else have any old business or new business? All right. Well, with that, I do want to thank you. Thank you all. I want to thank our new members. Jim, I told you these are quick. This is not like the Board of Finance.
No, you know, we just have about 3 more hours to go.
Yeah, this is an easy one.
This is like look at it, 8:20, and you're like, what do I do now with my evening? Tom, I'm so putting you onto the fund accounting and fee schedule committee when we create that.
I didn't even realize I volunteered. How'd that happen?
That's how we roll. New guy. All right. Well, you guys, thank you very much. We'll see you next.
To adjourn.
Oh, well, oh yeah. Hold on. Before we adjourn, I did have you have a handout kind of sent around, which is a schedule of the meeting dates and some topics, just so you get a sense of kind of how the calendarization of our meetings will go. That was Eric Caliber's great suggestion a year ago, and it helped a ton. So I'm repeating it this year. one thing I'll note is that this is not an OPEB year for us from an actuary standpoint, so we will have a different item there for March.
Just one thing, Carolyn. I think that one of the things that we missed last year that was never reported out from HR, just a brief report on the DC plan. That was one of the things that we've been kind of asked to oversee. Just making sure that the fees don't get out of control for the plan participants, or that investments change or come on or go off, and the percentage of loans that are taken against some of the DC plans. Maybe we could find a little space on the calendar, maybe in the June meeting or something, to just kind of have a brief 20-30 minute report out from HR on that. I think that'd be important.
I'm happy to ask. Happy to ask for that to happen. Jared, maybe you can help on that front.
Yeah, let me talk to HR, and we'll see if we can work something out.
All right, guys. Can I have a motion to adjourn, please? Oh, no one wants to make the motion. Eric Caliber, thank you. Tim Brown seconds the motion. 8:23. My God, you got all day ahead of you. Everybody, all in favor? I think we're all adjourned.
All adjourned.
Thank you all.
Night,
Thank you.
All right,
Good
thanks.
night.
Bye-bye.
Bye.
Night, guys.